Welcome to another edition of Market Insights. This is Steve Fernandez with Smart Profits Daily. In today's episode, I'm going to give you 4 ETFs you can buy, and I'll give you the reasons for each one. Before we get started, I ask that you please support the channel. Go ahead and hit the like button and the subscribe button if you like our content. After you subscribe, you can hit the bell icon. That's going to give you an alert anytime we post a Market Insights video. The first industry and ETF that I like is FinTech, the financial technology industry. To get exposure to the industry, you can buy the Global FinTech ETF, FINX. Why do I like FinTech? Well, first, the global financial industry is easily the largest in the world. It's estimated that it generates approximately $24 trillion annually in revenue. And driving that FinTech adoption, there's a few key catalysts. The first being shift in population demographics. As of 2019, millennials are now the largest population demographic in the United States, as you can see in this chart. And even the younger demographics are really starting to be dominant in the United States. And these demographics obviously tend to be a little bit more in tune with the latest technology. And as it turns out, they tend to value convenience when making consumption decisions, so purchasing or consuming. The next catalyst is going to be e-commerce acceleration. Everyone knows that retail is going more and more online. It's estimated that 16% of total retail sales in the globe were online, and that's expected to increase to about 22% by 2023. Meanwhile, digital payments will continue growing, and as you can see in this chart, mobile point of sale payments, which are using your smartphone at a checkout or a smartwatch at a checkout, for example, those are driving higher as well. And by 2025, these will be almost as high as digital payments in general. Now, I can assure you that the traditional checkout method will be obsolete I can't see it being here in even 10 years. It's just too easy to use your smartphone or smartwatch for many different reasons. The last catalyst driving FinTech that I'm going to mention is the crypto market adoption. Crypto markets aren't limited to trading cryptocurrencies. There's a lot out there. And when it applies to the financial industry, think crypto-based lending, crypto insurance, crypto banking, payments, obviously. There's a lot of different crypto avenues that are going to drive FinTech adoption. And the most obvious that we see in the publicly traded stocks in terms of crypto revenue is Bitcoin trading revenue. For example, Square derives most of its revenue now from Bitcoin trading and the fees it generates from that trading. And as the value of cryptocurrencies, in this case Bitcoin, goes up, the value of trades and therefore the fees it generates are higher. And it turns out that the amount of times that the market is trading Bitcoin is also increasing right now. So that's going to reflect favorably on these companies' financial statements and could be a long-term driver for FinTech moving forward. The next industry that's really hard to ignore is cybersecurity. You can invest in that by buying Global X Cybersecurity ETF, symbol BUG. Cybersecurity is really front of mind right now in the United States. At the end of 2020, there was a major cyber attack on the US government. It's rumored that Russian hackers were behind it. But if you ask anybody that works for a government agency, they will tell you that this was a disaster. And as you can see in this chart, this is not the first time that the US has had a problem with cyber attacks. About 38% of cyber attacks in the world actually are targeted at the US, but you can see that US cyber attacks are steadily increasing since 2005. Now, damage related to cybercrime is already estimated to be $6 trillion in 2021 alone. About half of that is from information loss, so loss of data and important information. This is only going to increase. Another catalyst behind cybersecurity is the growth in Internet of Things devices. So Internet of Things is, think a web of connected devices. So your smartphone, your smartwatch, your computer, your car, your smart fridge, whatever you might have that can be connected to each other is considered an Internet of Things connected device. Those are expected to increase by 3 times between 2019 and 2030. And the Internet of Things is very vulnerable. If a hacker can hack into your garage, they might be able to hack into your car or your phone. And if it scares you, it definitely scares businesses. 61% of businesses have already experienced a Internet of Things security incident. So you can see that as the world's reliance on technology and technological innovation moves forward, cybersecurity demand is inevitable. The next industry and ETF that you can buy into is the renewable energy industry, and the ETF is the Global X YLCO and Renewable Energy Income ETF, symbol YLCO. That was a mouthful. If you watched my last video on renewable energy, you can see that I did not recommend YLCO. I recommended TAN, FAN, and ICLN. But at this point in time, those have already been bid up. For example, ICLN is up over 50% since that video. And those trades were very obvious to investors. When it came out that renewable energy infrastructure spending was pretty much guaranteed with the Biden administration taking office and a fully democratic government, investors rushed into renewable energy trades. And one that they may have overlooked is the power grid. So Bloomberg estimates $14 trillion will be spent on the global power grid over the next 30 years. That's more than the spending on power capacity. So in order for this infrastructure spending to really play out and to take advantage of our investments in solar and wind, for example, more and more money will have to be invested into upgrading the power grid and distributing that power. Obviously, as I mentioned, ICLN has jumped a lot since the video, but as you can see, YLCO really has not moved much this year. In comparison to ICLN, YLCO has returned a lot less. It's up only 22% over the last year versus ILCN, which is up 151% over the last year. So you might ask, why YLCO? Well, YLCO is primarily invested in renewable energy grid companies, so companies that have been overlooked right now, I think. And these companies also pay dividends. So the dividend yield is roughly around 3% right now, but as these companies really grow with the grid investment that we're going to see, their dividends should also increase. So not only are we going to see price appreciation in the securities, we should also see an appreciation in the dividend payments over time. So this is an interesting way to buy into that renewable energy growth that is inevitable at this point. And the last industry, well, not necessarily an industry, but a pocket of the market that you can buy into is SPACs, special purpose acquisition companies. I did a video on it last month that you're welcome to watch if you want more details. It really is just a company that exists to take another company to the public markets through a merger. So the SPAC and new issue ETF, symbol SPCX, will give you exposure to a group of SPACs before they have entered into a merger. Why SPACs? Well, SPACs are really the new preferred way of accessing capital via the public markets. For example, in 2020 alone, there were 224 SPAC IPOs that raised a total of $74 billion in capital. As you can see in these charts here, SPAC IPOs have been pretty much non-existent over the decade in relation to traditional IPOs. But last year, not only were there more IPOs, there was also more money raised from SPAC IPOs. So there were only 172 traditional IPOs versus the 224 SPAC IPOs that I mentioned, and traditional IPOs raised $3 billion less in capital during 2020. Based on the time to market for SPACs and the ability to have better control over the amount of capital that they access, SPACs will probably be the new preferred method of raising capital into the near future. So this is good for investors because they can get in earlier, but also SPACs tend to target higher growth companies earlier in their growth curve in high growth industries. So by buying into this ETF, you can buy into SPACs before they have merged with another company. So that's going to be another high growth industry that you can invest in. Now, that's going to conclude today's edition of Market Insight. I hope that you enjoyed it and those 4 ETFs can be valuable for you. Tune in next time for our Market Insights edition, and we will talk to you soon.